Ever wondered how Warren Buffett built one of the most successful investment careers in history, turning a few $1,000s into a multi-billion-dollar empire? It's not magic. It's not timing the market. It's a series of time-tested strategies, backed by logic, patience, and discipline. In this video, we'll walk you through Warren Buffett's top 10 investment strategies, simplified for beginners. These principles have guided him, and can guide you, towards smarter, more confident investing. Let's get started. Number 1. Invest in what you understand. Buffett often says, never invest in a business you cannot understand. This strategy is deceptively simple. If you can't explain what a company does, or how it makes money in just a few sentences, you're taking a gamble, not making an informed decision. He calls this your circle of competence. The idea? Stick to businesses that are easy for you to evaluate. Think about it. Would you rather invest in a biotech firm with complicated clinical data, or a snack company with steady profits and strong brand loyalty? Buffett's example. He famously invested in See's candies because he understood their customer loyalty, pricing power, and simplicity. He skipped on tech stocks for years because they were outside his comfort zone, until he understood Apple as a consumer brand, not just a tech company. Stick to what you know. Simplicity beats complexity. Number 2. Look for a competitive advantage. Warren Buffett looks for companies with what's called an economic moat, a sustainable competitive advantage that keeps competitors at bay. This could be a powerful brand, proprietary technology, network effects, or scale advantages. Think of Google. It dominates search because of user data and algorithm superiority. Or Coca-Cola, even in blind taste tests, the brand carries immense influence. Why does this matter? Because companies with a wide moat are harder to compete with, and more likely to deliver consistent profits over time. Buffett's quote, "In business, I look for economic castles protected by unbreachable moats." Your takeaway? Don't just ask, is this a good business? Ask, what keeps competitors from stealing its lunch tomorrow? Number 3. Invest for the long term. Buffett's favorite holding period? Forever. While many investors panic during downturns or chase short-term trends, Buffett stays calm and committed. Why? Because the real wealth comes from compounding, and compounding takes time. Think of your investments like planting seeds. If you dig them up every few days to check growth, they'll never mature. But give them years, even decades, and the results are exponential. Buffett's example. He bought shares in Coca-Cola in the late 1980s. He still holds them. The dividends alone have paid back the cost many times over. For beginners, this means ignoring market noise, avoid trading impulsively, invest in quality, and let time do its magic. Number 4. Buy at a fair price. Buffett believes even a great company is a bad investment if you overpay for it. He doesn't chase price spikes. Instead, he waits, sometimes for years, to buy when a great business is trading at a fair or discounted price. This is where valuation comes in. Buffett looks at intrinsic value, the true worth of a company based on its cash flows, growth, and risk, and only invests when the stock trades below that value. Buffett's quote, "Price is what you pay, value is what you get." For beginners, tools like the price-to-earnings ratio, PE, PEG ratio, and discounted cash flow models can help you decide whether a stock is over or undervalued. Bottom line, great businesses don't always make great investments, unless the price is right. Number 5. Focus on quality management. A great business needs great leadership. Buffett places immense importance on management teams that are honest, capable, and aligned with shareholders' interests. He looks for managers who are rational capital allocators, transparent in communication, and focused on long-term value, not short-term earnings. Buffett's example. He's known for investing in companies where he trusts the CEO completely and rarely interferes afterward. For beginners, this means doing some homework. Read annual letters, watch interviews, look for leaders with integrity and a clear long-term vision. Number 6. Avoid excessive debt. Buffett avoids companies with high levels of debt, especially those in industries sensitive to economic cycles. Why? Because debt magnifies risk. During downturns, a heavily leveraged company may not survive. He prefers firms with strong balance sheets and plenty of cash on hand. For beginners, check the company's debt-to-equity ratio. Ask yourself, can they pay off their debt if revenue drops? Buffett also practices this principle personally. Berkshire Hathaway carries minimal debt and massive cash reserves. Number 7. Stick to your circle of competence. This ties back to our first point, but it's important enough to stand alone. Buffett stresses knowing your limits as much as your strengths. The more you try to understand everything, the more likely you are to make mistakes. Instead, focus on areas where you have knowledge, or a genuine interest to learn more. If you're passionate about healthcare, tech, or retail, start there. Ignore the hype around things you don't understand. Number 8. Be patient. Buffett's secret weapon is patience. He's waited years, sometimes decades, for the right opportunity, and when he finds it, he acts decisively. For new investors, this means resisting the urge to constantly buy and sell. Patience is a strategy. It prevents panic, reduces fees, and amplifies compounding. Buffett's quote, "The stock market is a device for transferring money from the impatient to the patient." Number 9. Reinvest earnings. Reinvesting dividends and profits accelerates growth. It's the rocket fuel of compounding. Buffett rarely takes out profits. He reinvests them back into growing businesses. For beginners, this means choosing dividend-paying stocks and opting for dividend reinvestment plans, DRIPs, to automatically grow your holdings. Number 10. Maintain a margin of safety. Buffett borrowed this concept from his mentor, Benjamin Graham. A margin of safety means buying assets for less than they're worth, to protect yourself from error or bad luck. It's like buying a $100 bill for $70. Even if you're wrong, you're not too wrong. This mindset is what keeps Buffett from risky speculation, and why his losses are often far smaller than others during crashes. Warren Buffett's strategies aren't flashy. They're not about chasing the next big thing. They're about clarity, discipline, and patience, and anyone can apply them, starting today. So, which of Buffett's rules will you use in your investing journey? Let us know in the comments. And if you found this helpful, don't forget to like, subscribe, and hit that bell for more beginner-friendly investing wisdom.